$2.5 billion for LIBOR, $7.2 billion for mortgage fraud, $258 million for sanctions, $630 million for mirror trading, $18 billion in total. The most fined bank in modern history. This is Deutsche Bank. It is Germany's largest bank and one of the oldest and most important financial institutions in the world, and it was founded in 1870 to finance German foreign trade, and it survived 2 world wars and the hyperinflation of the Weimar Republic and the division of Germany and the fall of the Berlin Wall, and over 150 years it became a symbol of German industrial and financial power, and then in the 1990s it decided to become a Wall Street investment bank, and what followed was 2 decades of the most comprehensive catalog of financial misconduct in modern banking history. LIBOR manipulation, mortgage fraud, sanctions violations, money laundering, tax evasion assistance, mirror trading, and the cumulative fines paid across all of these matters exceeded $18 billion, making Deutsche Bank the most fined bank in the world over that period. And by 2019 the bank that had once dreamed of rivaling Goldman Sachs and JP Morgan was worth less in the stock market than many of the scandals it had settled, and was executing a dramatic restructuring that amounted to an acknowledgement that the ambition of the previous 2 decades had been a catastrophic mistake. Deutsche Bank was founded in Berlin in 1870 by a group of German industrialists and bankers who believed that Germany needed a bank with international reach to support the expansion of German commerce, and from the beginning it had a global orientation that distinguished it from many of its domestic peers, and through the late 19th and early 20th centuries it became one of the world's most significant financial institutions, financing major infrastructure projects and industrial expansion across Europe and beyond. The decision that set Deutsche Bank on its ultimately destructive path was the decision in the 1990s under CEO Rolf Brewer and later Josef Ackermann to transform Deutsche Bank into a full-service global investment bank competing directly with the major American and British institutions, and this meant building a significant capital markets and trading operation in London and New York, and it meant acquiring Bankers Trust in 1999 for approximately $8.9 billion, one of the most aggressive acquisitions in banking history, and it meant hiring aggressively from Wall Street and competing for the highest margin, most complex financial products the market had to offer. The strategy did generate significant revenues, and for a period in the 2000s Deutsche Bank was genuinely competitive in the investment banking league tables, and its fixed income and derivatives businesses were among the most profitable in the industry, and Josef Ackermann famously set a target of 25% return on equity, a target that required taking risks that would later prove to have been excessive, and the bank met or approached that target in some years through the aggressive pursuit of high-margin trading and structured products. But the Wall Street culture that Deutsche Bank imported along with the business also imported Wall Street's problems, and the LIBOR scandal was one of the most damaging. Deutsche Bank was found to have participated extensively in the manipulation of LIBOR benchmarks, and in 2015 it paid $2.5 billion in penalties to American and British regulators, one of the largest individual fines in the LIBOR scandal, and 2 of its subsidiaries pleaded guilty to wire fraud charges. The mortgage crisis exposed another dimension of Deutsche Bank's misconduct, and the bank had been a major participant in the American subprime mortgage market in the years before 2008, originating and securitizing subprime mortgages and selling them to investors. And in 2017 Deutsche Bank paid $7.2 billion to the United States Department of Justice to settle claims that it had misled investors about the quality of mortgage-backed securities it had sold in the years before. The financial crisis, one of the largest mortgage-related settlements of the post-crisis period. The Iran and Russia sanctions violations were another chapter, and Deutsche Bank paid $258 million in 2015 to settle charges that it had processed transactions that violated American sanctions against Iran and other countries, and subsequent investigations revealed that the bank had processed approximately $10 billion in suspicious transactions linked to Russia through what became known as the mirror trading scandal, a scheme in which Deutsche Bank's Moscow office helped wealthy Russian clients move money out of Russia by buying securities in rubles and selling identical securities in dollars in London, effectively converting rubles to dollars for clients outside official channels. And Deutsche Bank paid $630 million to settle mirror trading charges in 2017. The bank also faced serious questions about its relationship with Donald Trump, whose business had borrowed hundreds of millions of dollars from Deutsche Bank at a time when most other major lenders would not extend credit to Trump's businesses. Following multiple bankruptcies and investigations by the United States House of Representatives sought information about Deutsche Bank's Trump-related lending, though the bank's direct legal exposure from this relationship was limited. The cumulative weight of fine settlements and the ongoing costs of litigation and legal compliance, along with the fundamental question of whether Deutsche Bank's investment banking strategy was generating adequate returns relative to the risks it was taking, led to a series of strategic reviews and restructurings, and in July 2019 Deutsche Bank announced a major restructuring that included the elimination of its global equity sales and trading business. One of the businesses that had been central to the Wall Street ambition, the departure of 18,000 employees globally, and a fundamental reorientation of the bank toward its European corporate banking and wealth management businesses and away from the global investment banking ambitions that had guided the previous 2 decades. The share price by 2019 was trading at levels that valued the entire bank at less than some of the fines it had paid in individual settlements. A situation that reflected not just the financial costs of the misconduct but the fundamental question about whether the strategy of the previous 20 years had created any lasting value for shareholders, and the answer implicit in the share price was, it had not. So what is the real lesson of Deutsche Bank? And the lesson is about what happens when an institution imports a culture without importing the controls that are supposed to balance that culture. And Deutsche Bank brought in the risk appetite and the revenue targets and the compensation structures of Wall Street investment banking, but it did not bring, or did not successfully embed, the compliance and risk management cultures that were supposed to constrain those appetites, and the result was that the bank's various businesses operated with a degree of freedom that generated short-term revenues but also generated the scandals that ultimately cost far more than the revenues had been worth, and the bank that spent 2 decades trying to become Goldman Sachs ended up instead becoming the most fined institution in modern banking history. And the lesson it demonstrates is that culture is not separable from strategy, that you cannot import one without the other, and that attempting to do so produces exactly the kind of institutional dysfunction that Deutsche Bank exhibited. That is the capital case. Subscribe to the capital case because the next case is already waiting.